Good evening, ladies and gentlemen. My name is MICHALIS, EFTHYMIOU, and I'd like to welcome you to today's webinar about trends and how to trade them. Welcome everybody to today's webinar with Stratton Markets. As I said, today we're going to be concentrating mainly on trends, how they evolve, what is causing the trend, and how we can trade and hopefully profit from them. Now, during this webinar, I recommend that everybody has a pen and paper to hand so they can write notes. If you do have any questions with regards to what is being spoken about, please wait till the end, and at that point I'll leave you with some time to ask any questions. Alternatively, I will have my email address at the end of the webinar. Feel free to send me an email at any point. Now, just to start off today's webinar, I just wanted to give a very quick introduction to myself. I am the market analyst here at Stratton Markets. Main thing that you need to know really about myself is that I have been trading CFDs for quite a while now. And I've been a financial advisor in the UK for quite a few years. That's where I started off in the industry. Now, for anybody who has possibly maybe just recently joined Stratton Markets, I just wanted to give you also a quick introduction with regards to Stratton. The main thing that you need to be concerned about is that Stratton Markets is a fully regulated brokerage firm. Now, they're fully regulated by SISEC, which is a European regulator following European laws. Now, we have our very own trading platform, or if you wish, we also have the MetaTrader 4 platform. So you have a choice of trading for one or the other or both. Now, we have a weekly seminar which we have designed specifically for educational purposes every Tuesday at 6 o'clock UK time. Now, I want to very quickly make everybody aware that here at Stratton Markets, we are a CFD brokerage. Therefore, you are making an investment. Of course, investments are bearing risks, okay, as do all investments. So I recommend that you do your research with regards to what risk is involved in this specific investment. Now, just to look at today's schedule, we're going to start off, especially for all the new traders, with some Forex basics, looking at some of the terminology and maybe some words that they're hearing their account manager continuously mention, what exactly they mean and how do they relate to the financial trading markets. Also, we're going to be looking at market retracements. Do not worry if that doesn't make sense to you. We're going to be covering this as part of today's webinar. Price corrections, trend, trying to catch a falling knife. I will explain what that is. It's a massive part of trading that everyone needs to be aware of. We're also going to look at some strategies also. Now, first things first, the most important thing that you need to know, the first thing that you need to know when you're investing with Stratton Markets is that you are trading something called CFDs. Now, CFD stands for contract for difference. Now, CFD trading allows you to speculate on the rising or falling of the prices of specific securities. For example, Forex shares, commodities, maybe cryptocurrencies. Now, with CFD trading, you are not actually buying the asset itself. All you are doing is you're buying a contract which is mimicking the price movements of that asset. So, for example, if you, let's say, buy 10 Apple stocks, you don't actually own the stocks. What you own is a contract in Apple stocks. Why would you do that? It's because you can profit from the price movements if you are trading in the correct direction. One of the advantages with CFDs is something called leverage. Now, some people view this as an advantage, some people view it as a disadvantage. Leverage is known in the market as a double-edged sword. If you are, a very good trader and you are trading the correct direction, then leverage will, of course, be multiplying your profits. However, if maybe you are a new trader and not trading in the correct direction, then it will be multiplying your losses, which is why we call it in the market a bit of a double-edged sword. So let's have a look at leverage. Now, as I said, leverage is a massive part of CFD trading. It is sometimes the reason why people prefer to trade CFDs and instead of actually buying the asset itself. Or maybe possibly it's why people will stay clear of CFDs. So what is leverage? Leverage is when the broker is allowing you to control more capital than your actual investment. Now, what does that mean? Let me give you a very quick, easy example. If you are investing $1,000 into your trading account, and just for example, you have a leverage of 1 to 100, it means that you have the power to invest up to 100,000 into the markets. Now, let me make sure everybody understands this correctly. It doesn't mean you have 100,000. You still only have 1,000 in your account. However, you can be trading up to 100,000. Now, what this means is that every movement in the market is being times 100. This is why I say when you're making a profit, it's great because your profit is being times by 100. If you're making a loss, it really is not beneficial because, again, your losses are being times by 100. This is the reason why we are calling it a double-edged sword. Now, a lot of people have been emailing me, asking me how exactly can I calculate how much the market has moved in terms of pips. Now, just for everybody to be aware of, I'm going to go to the previous slide. The pip movement is the 4th decimal point. So if you look at the laser here, this here is the pip movement, okay? So the 4th number after the decimal is 1 pip. Okay, so how exactly are you calculating how much pips the market has moved? The first thing you need to know is exactly how much you are trading. So you're trading 1 lot, you're trading 2, you're trading 3, you might be trading a mini lot. Okay, that's the first thing you need to know. Second thing you need to know is at which point in the market you entered and at which point in the market you exit the market, or planning to exit it or planning to enter it. Now, the difference between the two, okay, these 2 points, is the movement in the market in terms of pipettes. Now, if you want to turn it into pips, what you are doing is you're dividing it by 10. That will give you the movement in pips, not pipettes. Now, if you know the amount of pips that is moved, the platform, of course, is going to give you the pip value. You'll be able to establish exactly how much profit or loss you will be making in that specific trade. Now, moving over to trends, which is what I base this webinar about. Now, what exactly is a trend? Now, a trend is a tendency for a price of a specific asset to move in one direction over a period of time. Now, trends can be long-term, they can be short-term, they can be an upward trend, downward trends, or even a sideward trend. It could be a trendless trend. So in a sense, it's not having much volatility. It's keeping to a very small range and not really moving that much. Now, success in the Forex market and your investments, okay, is tied to your ability whether you can identify trends, number one, and also position yourself to profit from those trends. If you are unable to identify these 2 points, it's highly likely that you're not going to be a profitable trader. Now, for the most part, an economy that is strong, okay, is likely to have a strong currency behind it. Now, trends and prices of assets, whether it's currencies or maybe stocks, maybe commodities. Let's take currencies, for example, as well. Their prices are going to be determined by the supply and demand. Okay, supply and demand by investors. If they've got a high demand, then it's likely to be priced high. If it's got a low demand, it's likely to be priced low. Now, economic strength is going to attract investment, and the investment creates demand for the currency. Now, if there's demand, it means it's going to be going up in price. If the demand is starting to become weaker, it's likely to weaken in price. Now, I'm going to give you an example of how the demand later on in the webinar, how demand can make a currency move specifically high. Now, I want to give you an example of a trend. And we mentioned also on the schedule about retracements. So what exactly is a trend? We've spoken about that. Now let's have a look at what a retracement is. Now, no matter how strong a trend is, it will always have something called a retracement in the market. Now, I've got a chart down here. It's the pound against the US dollar on an hour chart. Okay, what direction do people see this trend moving? Okay, is it an upward trend? Is it a downward trend? Or is it a side movement trend? Okay, hopefully everyone has said that it's an upward trend. As you can see here, it's very clearly gone up. Now, what exactly is a retracement? Now, these points in the market where there's a temporary pause or change in trend, okay, it's at that point that we call a retracement, okay? Sometimes if it's a big movement, let's say like this one here, you can refer to it as a price correction, okay? So whatever it's gone up by, it's just corrected in the opposite direction. And some are called retracements, like these smaller ones here, okay? Now, no matter how strong the trend is, we can see here that it is a very strong trend. It's a massive upward trend, that it will have retracements. Sometimes the stronger the trend, the larger the retracements. Sometimes the stronger the trend, it could be that you're not seeing many retracements. Okay, now why do we see retracements? It is at the point of the market where traders tend to be selling. Okay, it tends to go down, people start buying again, and then it pushes it back up. Now this is what the trend, this is what the the retracement is in the market. And we're going to look at also how you can benefit from one, the trend, so trading upwards or trading downwards and earning from the retracements. Now, I wanted to give you an example about how trends can form. Now, I'm looking at the euro against the Australian dollar, okay? We can clearly see here that between 2008 all the way up to 2012, there was a massive, massive downward trend that's moved thousands of pips, okay, for over 3 years. Now, this is, I wouldn't say a rare trend, but not something you specifically see every single day, a trend lasting 3 years long. Now, this trend is a great trend. You can be profiting if you're trading in the right direction for a trend like this. The point of the webinar is to try and predetermine when a trend is going to form. So let's look at this as an example. Now, this is an example of how and to identify a long-term trend. Factors in other economies should also be considered, since there is never a single currency. You'll always see two currencies like so. So you have to take into consideration the euro as well as the Australian dollar. Now, note how the economic factors in this case, a demand for gold and the high interest rates in Australia between 2009 and 2012 created a demand for the Australian currency. This type of demand will last until the exchange rate becomes too high and negatively affects Australian exports. Okay, so we can clearly see that the high interest rates and demand for gold is likely to cause a long-term trend. We can see that the trend here lasted 3 years. So why, first things first, why is gold affecting the Australian dollar? It's very simple. Australia is one of the biggest suppliers of gold. They hold large amounts of gold in their gold reserves and also in their soil. So that is why gold is affecting it. Now, if the price of gold is going up and the demand of gold is going up, there's going to be a demand for the Australian currency. Also, interest rates, why is that affecting the currency? The higher the interest rates go, the higher the currency goes. The lower it goes, the lower the currency goes. Why? Because higher interest rates is indicating that the economy is growing extremely fast. You want to be investing your capital where there is, of course, a healthy economy. Okay, so knowing that gold prices are going up, knowing that there is a demand for gold, gold is the safe haven, people are investing in it, most likely because of the economic worldwide recession. Also, high interest rates, you can be pretty sure that a trend is going to be forming in favor of the Australian dollar, which is why we see this massive long 3-year trend. Now, I wanted to also speak about trying to catch a falling knife. Now, this is one of the mistakes that a lot of traders come to Stratton markets, and in general across the financial trader markets is something that they try and do, is that they wait for a currency to drop. They buy it because they believe that they're buying the dip. It keeps on dropping, they buy again, and then they buy again. The trend is continuing until it blows their accounts. Okay, so this is why I've done a specific slide with regards to trying to catch a falling knife. Okay, or sometimes it is referred to as bottom fishing, so trying to find the bottom. Something that I want everybody to be aware of is, yes, buying low is something which you can look at. However, you need to take into account analyzing the market. So why is it dropping in value? Is the reason it's dropping in value going to have a long-term effect, or is it going to have a short-term effect? Why is it at this point now going to change trend? Now, these are the type of things you need to be looking at as a trader. So I want everybody to be aware of before entering a asset which is falling in price, to analyze as to why it's falling and why is it about to change. Now, I wanted to also give you a couple of strategies with regards to trading a trend. Now, there's always trends in the market, whether they're long-term or short-term trends. What the difficulties are in when to exit and when to enter the trends. Okay. Now, this is a very easy to understand strategy, which has been around for quite a long time and is used on quite a few occasions. It's called a crossover strategy. Now, the two lines that you can see on the chart are called moving averages. Okay, so it's giving the average price over a specific period of time. The yellow is a 5-day moving average. The red is a 10-day moving average. And this smaller chart at the bottom is called an RSI. Now, how are these indications going to show you when to enter and exit a trend. First things first, the entry is being shown by this crossover here. Whenever there's going to be a crossover, it is an indication that a trend is going to form. The trend could be short-term, it could be long-term. However, it is giving you the indication of the trend. So you got the first indication here. You enter. The indication is correct. It is moving in your favor. It's moved at least 50 pips. So that is an accurate indication. So that's your entry points. When to exit. The exit point should be at the point that the RSI, so the blue line, is heading towards the dotted line at the bottom. When it's getting close to the dotted line or it's hitting the dotted line, you should be coming out of the market. So at some point here, you should be leaving the market, whether it's here or maybe even lower if you're lucky. And then you got another crossover here, and you can see it's going massively up. Okay, this is an even bigger trend. When you should be exiting the market, it's when it's getting close to the resistance, which is about some point here. So you're making that profit there. It has also crossed over here. It hasn't specifically made a long-term trend. It was a trend that was very short-term, about 8 hours. Nonetheless, it was a trend. So this one here might have been a profit and might have been a loss. Crossover again. This one would have been a profit. Crossover again. This one would have been a profit. When is it hitting the RSI? About there. Okay, so you would have entered here, exited there. Same thing here, and also here and here. So this is a 2x2 strategy. It's a crossover strategy, and you're using the RSI and the moving averages of when to enter and exit the markets. Now, this is a bit more of a advanced indicator. It's called an Ichimoku. Okay, that's how it's spelled here if you want to do your research. Now, that might sound gibberish. I don't blame you. It is a Japanese word. Okay, now Ichimoku is made out of two clouds, which is these shaded areas here. So you got a bullish cloud and a bearish cloud. Okay, and then you got two moving averages, which is the red and the blue. Now there is two ways that you can enter and exit the trades using the clouds and also the moving averages. First one is the crossover, which we've already spoken about. Now, if you're using the crossover, you need to exit at a point that it is hitting the cloud. So for example, if you're entering here, okay, then you should be exiting when it's hitting the cloud. At this point is likely to find a resistance. Now, sometimes it's not going to be hitting the cloud like the crossover here. It might not necessarily be hitting the cloud. Okay, what you can use is an RSI instead. So the crossover was quite accurate. It was very accurate here. We saw a massive trend. We saw a massive trend again. It crossed over again, and we saw a massive trend. Now, as stated, you can use an RSI when to exit. If it's not too close to the cloud like here, you can use a cloud as a point of exit. If it's very close here, then of course you cannot use it. Same thing's happening here, in which case you would need to use an RSI or maybe fundamental analysis. Now, with regards to earning from a retracement in a trend, we spoke about what the retracement is. I'm using the pound against the US dollar again. 1 hour chart is the exact same as we saw before. As you can see by the red support and resistance points, it is very clearly an upward trend, but does have many retracements in the market. So how exactly can you pinpoint when there is likely to be a retracement? Now, you can use the support and the resistance lines. So you can plot this line here, and then each time that is hitting this resistance point or even getting close to it, like it's got close to it here, then you are entering for the pullback. Alternatively, you can use an RSI, in which point when it is getting close to the top dotted line, like here, like here, like here, also here and here, then there's going to be a retracement in the market, as previously said. Now, everybody should be aware that a trend like this, you'll most likely be trading long term, okay? Retracements need to be shorter, okay, than the trend. If it's bigger than the trend, then it's not a retracement, it's a correction in the market. Now, instead of plotting your own support and resistance lines, which I know can be quite difficult, and I have had people emailing me saying that it's quite hard as to draw yourself your own support and resistance lines. You can also use a moving average. So I've got a 50-day moving average on the chart here. This time we're looking at the pound against the Japanese yen. We can see it's proven to us a point of resistance. So it drops down a little bit, goes up, hits the moving average, goes down, hits the moving average, goes down, hits the moving average, goes down. It's at the point of the moving average that is finding resistance. So instead of plotting your own resistance lines and support lines, you are able to use the moving averages instead. Alternatively, as stated before, you can use an RSI as to a point of when you are likely to find support or resistance. Now, when to get out of a trend. Now, we've said when to enter the market. You can use the indicators, the RSIs, the moving averages, Ichimoku, etc. Now, that is how to get into a trend. You can also use fundamental analysis. Now, when to get out of a trend. It is just as important to know when to get out than to know when to get in, okay? First things first, do not be greedy. Set a target, aim to reach that target. If you've reached it, get out. Alternatively, if you're using an indicator like an RSI as to a point of when to get out the market, follow the indicator. Do not get greedy and hold on to the trade too long, because it might mean that it's going to halve your profit or wipe out your profit or even turn a winning trade into a losing trade. Also, the same applies when the market is moving against you. Set an amount you're willing to risk. So let's say if you're trading one lot, say you're willing to risk 50 pips, okay? If it reaches that point in the market, you had a bad trade, you analyzed the market wrong, maybe something unexpected happened in the market and moved against you, then you've set that that's a point in the market that you're not willing to lose anymore. Do not change that point. So don't put 50 pips is when I'm coming out the market, then it's at 45 and you change it to 60. Then it's at 55 and you change it to 70. What will happen is the market and the trend will keep following your movements. Okay, so be strict with regards to when to exit the trend. Now, I've spoken quite a lot about indicators in today's webinar. Indicators are great. You know, I've used them in my trading. They're widely used by a lot of traders. However, indicators have never ever been 100%. So there's a few things that you need to do when using them. You must have a risk management plan. You must be mitigating your risk. You must also be trading assets which are not overexposing you to one part of the market, okay? So it's very important to understand that an indication is not the word of God. It can be a false indication. The indication can be incorrect. What I'd recommend is maybe using more than one. I wouldn't recommend using more than three though. Okay, so try and spread the risk against different indicators. Follow your trading plan and follow your risk management plan, of course. Now, that brings us to the end of today's webinar. Now, the trend is a great part of the market. I hope that today's webinar has given you an indication of how you can use indicators to establish when there's going to be a trend in the market and also when to get out of the trend also. Now, if you do have any questions, please feel free to email me at michalis@strattonmarkets.com. Thank you for watching today's webinar with Stratton Markets. Please trade safe and trade responsibly. Thank you.